What is up, hackers? Welcome back to another episode of Hack Crypto, where we hack all of our crypto education. If you guys are brand new here, be sure to be subscribed with notifications on for my next fire video. Now, in this episode, I'm going to be going over Arch. This is a new crypto-backed loans platform that is super cool, and they just raised $75 million in both debt and equity. So on the topic of collateralized loans, when someone provides the collateral itself that they are borrowing against, it is a very low risk loan because effectively you are providing an asset that is liquid to a lender, and they are giving you a loan with an interest rate that's usually fixed. And when that asset is going up and down in value, there are different things that happen, but ultimately all you need to understand is that a collateralized loan is lower risk on the lender's part. So therefore, terms can often be pretty favorable. And by favorable, I mean that there are no credit checks. There is a couple of different assets that you can utilize in the crypto space specifically. And ultimately, you have a fixed interest rate of about 14% and a different LTV or loan to value ratio, depending on the asset itself. So you need to provide more of the asset to get more on your end in terms of cash in the bank. And the last, but most certainly not least valuable aspect of borrowing against assets is this is non-taxable. When you are borrowing against anything, whether it's your home or crypto, there are no taxes towards debt that you are taking on. That's why the highest net worth people in the world borrow against their assets to acquire more assets. This is a fundamental piece to growing wealth over time. By not liquidating assets and just borrowing against them, you are able to continuously compound that growth and just do more ventures and do more business and do more investments by not liquidating and just borrowing against. Because when you do sell different assets, you are going to be paying taxes. You are going to be paying capital gains and income tax and all of that. So when you're borrowing debt, that is not a taxable event. So that was one of the biggest claims that BlockFi used. And I used BlockFi back in the day and was really excited about them. And they did an incredible job growing and really taking care of customers. They partnered with a couple different servicing companies. And ultimately, they got acquired by FTX. We all know how that turned out. So it wasn't necessarily, in my opinion, BlockFi's fault that things went completely kaput because they got acquired and the acquiring company just exploded in a epic fashion. So when I see new lenders coming out, raising 75 million, storming into a market for not only individuals, but institutions like Arch, I get super excited because these types of instruments unlock so much potential because you have millions and millions of crypto holders that are sitting there not wanting to sell those assets. So what I want to do in this video to show you guys how excited I am about Arch and of course Unchained and a lot of the other platforms out there, I want to talk about why this is so important, why this instrument is so key to unlocking people's capital and getting that moving. This is not a sponsored review. I saw an announcement about this $75 million raise, and I jumped onto their site and said, whoa, this is like a brilliant business. More and more people need to be looking into collateralized loans in the crypto space specifically because they are locked up, they're hodling, and this type of security that they are providing for Bitcoin, Ethereum, and Solana holders is pretty unparalleled. They're doing an incredible job with the security itself, and that is a value proposition that they're putting forward. So you have security, you have no credit checks to get the loan, you have a fixed rate, you have these different assets like Bitcoin, Ethereum, and Solana, probably more coming, and ultimately you have the ability to have that debt, and it is not a taxable event taking place. You are not liquidating those assets. So you can use it to buy rental properties, start businesses, do all different types of things, and free up some of that cash sitting in your crypto positions so that you can do more. So let's jump onto the Arch lending site, and I'm going to walk you guys through the individual side and then just take a peek at the institutional side because I think that's really exciting that they're providing liquidity for both parties. So let's jump onto the website. As you can see, they have their announcement, 75 million in equity and debt to accelerate the future of crypto-backed lending. Love that announcement. I'm going to go through the quick terms here. Support for Bitcoin, Ethereum, and Solana. No rehypothecation. That means that the collateral is stored in custody by them. It's not lent out to other individuals. That is a key ingredient here that Coinbase got into trouble with. And this is just something that you really want to make sure that any lender that you're going to is not moving those funds elsewhere. So no rehypothecation is a key ingredient here. Fixed terms, 14.5% interest rate. Check that out. 1.5% origination fee. That's likely to probably go down over time. In my experience, a lot of times when it's a startup, they're trying to increase revenue and grow. So that's likely to probably drop to 1% over the next few years. And no credit check required. very crystal clear here because you're providing the asset up front. There's no need for a credit check on the individual because you're literally providing the asset up front that can be liquidated. As you can see, preserve your crypto for growth, avoid taxes, and get cash when you need it. Top-notch customer support and peace of mind knowing that it is not getting rehypothecated. That is such a cool aspect to this, and I love that they've brought that front and center. So as you can see at the time of recording this, one Bitcoin being worth about $60K, you have 37,000 at a 14.5% interest rate over 12 months at a 60% loan to value ratio. Now they have different options, ETH, Solana, but ultimately most people are going to be using this for Bitcoin. The previous video I did on Unchained, a lot of people talked about how important this was. So if you are interested in the higher loan to values, I think Bitcoin is probably the highest one that they're going to have because it is the lowest risk in every measurement. So you can see that the loan to value on Solana is dramatically lower there, and Bitcoin is the highest because it is the king. That is how it works. So you can see that they have the security of Anchorage, which is super fundamental here. Anchorage is one of the OGs in the space, very, very powerful and well known, with a federally chartered bank. And they have a lot of cold custody options there. So that is really a fundamental part here in that there's trust and security to the business behind the scenes. A lot of customer support value there. And then of course, why to do it. So day-to-day finances, debt consolidation is pretty key. And then of course, investing in businesses. I always recommend hodlers that are starting companies, that keep away from liquidating those assets and try to do your best to start new businesses using this type of product. And you're avoiding a taxable event and potential gains because you're not actually selling the asset itself. You are pulling and borrowing against it. So very important to know that. So they have a lot of really good backers. Morgan Creek, funny point there is that is Pomp, or it used to be Pomp, and they backed BlockFi back in the day. So I don't know if Pomp is still there, but ultimately seeing that investment here means that thesis is still strong. Like they believe in the thesis, and I do as well. I think that this is a valid financial instrument that people are going to be using for decades to come. So let's go to institutions real fast. I want to make sure that we cover this because this is a mega industry. You got miners, you have funds, family offices, exchanges that need liquidity and they don't want to liquidate. And it's just so important to know that with institutions using this, that makes the company stronger. So if you're an individual thinking about, hey, I'm going to borrow against this to start a business, my Bitcoin or my Ethereum or Solana, whatever, it's important to know that the more institutions that use Arch, the more powerful and de-risked they become. And that's a really important ingredient here. So I wanted to make sure to mention that to people that are like, oh, I don't know about their security. I don't know about how long this company is going to be around. But anybody that raises 75 mil in equity and debt and is also working with miners and family offices and exchanges to support them with collateralized assets, like they're literally getting these assets from miners and exchanges. I think that that's a really foundational point here to mention that is what is going to be backing these the business and making it even stronger over time. So the last thing that I want to talk about here is the startup equity backed loan. This is really interesting to me because this is borrowing against the shares of a company. And I think that there's a lot of other people that do this, but I think that they're trying to create a kind of a symbiotic relationship between products where you have crypto founders, like people that are in the Web3 space that have built businesses and they have equity and they're trying to, maybe purchase a home, rental properties, start a side hustle or whatever. I think that there's so many different things that go into helping individuals like myself and other founders out there. So it's cool to see them creating complementary products like this. So get up to 5 million, 35% LTV, 10 to 15%, and 20 plus companies supported, flexible payment schedules, and a one-time equity fee. So they're definitely in this space. I want to know your thoughts in the comments below, how you guys view the startup equity piece mixed with the crypto backed loan product, because they're definitely building it for a persona, a very specific type of borrower. And I think that adding products to that is really important. That's it for my overview of Arch. I'm super bullish on the concept of crypto-backed loans. I think that it's a beautiful, beautiful institutional product and an individual product for people out there that are watching this. So check it out with the link in the description below. Definitely do your research. Check out the loan to value ratios on the assets themselves. And what I will say, this is not financial advice by any means, but the people that I've followed for many years always talked about borrowing when it's low. Putting your assets in a secure platform like that, borrowing against them when the prices are low, because the crypto space is volatile, guys. Things go up and down quickly. If it drops down too low, you're going to get a phone call saying you need to add more collateral. To avoid getting margin calls and partially liquidated on the assets that you've put up there as collateral, needing to top it up, definitely borrowing when it is lower before the bull run kicks off, which we are in the midst of the largest bull run of all time in crypto. So borrowing sooner rather than later, not financial advice by any means. That is what I have done in the past when I did a crypto loan like this on BlockFi previously. And I highly recommend just doing research on this, understanding how the liquidity works and how borrowing against these different assets works. So that is it for this video. Slap a like on this. Let me know your thoughts about crypto-backed loans in the comments below, and check out Arch as well. I love seeing new projects coming out, pushing out really fundamental instruments to move the space forward, and helping builders and institutions borrow against those assets without liquidating them is such a key ingredient here. So that is it. I will see you here on the next episode of Hack Crypto.